Very cool.
Right, I think that's us live. Okay, welcome to another episode of the Scottish Property Podcast. My name's Nick Ponte. I'm here with Stephen Clark. How you doing, Stephen?
Good, Nick. Good.
Good.
Put me on the spot for some an update on a chat on current market, current conditions today.
Well, I was actually looking back. The last time we sat down, just the two of us, and talked about market conditions was back in January. Remember, I was out in Florida, and at that time, we were giving our predictions for the year, and we were both pretty optimistic, but a lot has changed in 6 months. So we thought we'd do another catch up and look at what has changed because, back then we didn't have a war in Ukraine. We didn't have rising interest rates. So we've got a lot to talk about. So we're doing this as a live stream, guys. So if anybody's got any questions, comments, please put them in the box. If you're listening on Facebook, LinkedIn, or YouTube, just fire in some comments. It'll be good to see what you're thinking on the current state of the economy and how that's going to affect house prices. So I'll start it off here, Stephen. We've got, the highest inflation in 40 years, I think. We've got the highest interest rates in 13 years. Are you scared, Stephen Clark?
No.
I was hoping you'd bring a bit of positivity to this because you know me, mate. I get a bit kind of bogged down in all the headlines. I've been actually watching far too much news lately, and it does really affect your view on it. So, what are you thinking? I mean, obviously, just to cover things quickly, we've got inflation predicted to be peaking at 11% later in the year. First of all, let's start with inflation. Are you actually noticing? What are you noticing in terms of obviously cost of fuel and all the rest of it?
I think we said before on the podcast that we predicted that the inflation was going to be a lot higher than what's getting publicised, because the stuff that we were talking about on the podcast was timber and certain materials that we use day in day out on our renovations. I think we were even chatting about the cost of ham went up from £2 to £1 to £1.20 or something like that. And it was like that's a 20% increase. So I think a lot of the inflation we kind of predicted was coming, and I still think that it's hidden. I think it's a lot higher than it actually is. We've noticed that we have noticed this for probably over a year, I think. So yeah, I've certainly noticed that. You certainly do notice a lot of difference in stuff, but particularly fuel at the moment. Energy prices. I was on a variable rate for one of my business premises. Didn't put on a fixed term, and my estimated bill that I've been paying, I had to pay an extra £4,500 there for the last 10, 11 months. So there's a huge increase in cost of living.
I think it's really fascinating stuff, I've got to say, and I've been really enjoying learning about it as well, because prior to all this happening, I didn't really know too much about the macroeconomy. So talking to people like other podcast guests like Adam Lawrence that we've had on the show, and obviously reading a bit more into it, times have changed. We have been so used to having low interest rates for the past, and a lot of our listeners, who are new to property won't even remember, pre-2008, where interest rates were a little bit higher, maybe like 5%. They won't remember that. And then, we've been so used to just kind of trundling along on, underneath 1% base rate.
Pick up key for new and Frith property.
Sorry, something's happened there with my notifications. So this is like strange territory for a lot of people. So looking at the inflation thing, a lot of people thought, this was just going to be transitory. It was going to be quite quick, and then it was just going to dwindle away as the supply chain problems, were solved. But now it just definitely looks like it's going to be a lot more embedded. I think the war in Ukraine has obviously worsened it with the oil prices and the energy crisis and all the rest of it. You've also got economists talk about where it really starts becoming a problem is when, wages start increasing. And you see that quite a lot at the moment. I mean, just for example, myself, we're trying to hire for the letting agency at the moment. And, a normal letting agent salary, which is not that high, to be honest with you, I put it up on Indeed, and I'm hardly getting any inquiries. Literally can't get any decent people for the job. So I've noticed that people are really increasing their salaries as well to try and get good people. And once that starts getting embedded in the whole system, rising wage inflation, then it must be really hard to get out of that. So I think the inflation thing's going to be with us for a good while. And of course, the reason as property investors that is so important is, it's all interconnected, because what the Bank of England doing to try and combat this inflation, they are rising the base rate up, the interest rate.
I think it was the chairman of the Bank of England said this probably about 6-7 months ago and warned us. I'm sure there's an article that was getting posted. I'm sure it got posted in the Scottish Property Podcast Facebook group saying that, once it comes to this inflation media scaremongering, don't start pushing for higher, wage increases by saying, "Oh, we're only getting 2 or 3% increase, but the inflation's at 10%. We want 10, 15% increase," because that was what happened. I think he said back in the 70s, the last time we saw inflation at this rate, and it caused it kind of was a hyperinflation where it took years to recover from it.
A lot of people are drawing comparisons, like you say, back to the 1970s, but the difference here is we have had whatever it is, 10, 12 years of constantly pumping money into the economy as well. So QE, which is basically the money printing. So the central bank.
Not to mention the last 2 years, we printed almost a third of the money we printed in history in the last couple of years.
Yeah, so much stimulus, all this money, and eventually we're paying for it, and this is what's going to happen. I think eventually we're going to have to pay for it one way or another. Now they're trying to wind up all this money printing, but it's too late. This is what's contributing to the crazy inflation as well.
And we spoke about that and how it ties back into property prices. I looked up before we came on this call what the property prices have risen in Scotland the last 2 years, and apparently it was 10.4% as an average, and 10.8%. So we've had a double figure increases, and I do think we're probably going to get about 15% increases this year. So you've had that huge double digit increase in property prices the last few years, but that's always the height of the property prices before something happens, doesn't it?
Yeah, I mean, with regards to property prices, I think I would disagree with you there. I can't see them going much higher. I think they're going to start reducing. So, I think at the moment you're seeing on average 10%. That's my personal opinion, by the way. We all could be wrong. But already there's signs coming through from, I think there was some Rightmove data put out this morning in the press where it said already, things are definitely starting to slow. Time of property on the market is increasing. There's estimates from different, Zoopla, Rightmove. They're predicting that possibly prices could fall from 10% year-on-year growth to maybe 5% by the end of the year. So I'm kind of tending to go along with that.
I agree that I don't think there's a crash coming. I think the kind of inflated price in the last 6 months to a year is what's going to drop back down. So most of the agents I've spoke to over the last 6-7 months have said that everything that was going in the market was going for between 10 and 20% over the asking price. Now I think that's the peaking. I don't think there's going to be a crash. I just think that we'll go back to the normal. So whatever it was a year ago, that'll be the kind of price that'll settle it. But I think that's where the media gets a hold of it and twists it and says, that 4-bed detached house was selling for X amount, it's now down 20%. When it wasn't really. Someone was just willing to pay 20% over it because of the way the market was. So it doesn't necessarily mean that the prices went up 20%, it crashed 20%. Someone's paid more than they should have, is my opinion on that.
And it's all location specific as well. It's going to really vary where you are in the country. So, for example, where I'm based in Glasgow, you've got the Glasgow West End where things were going to closing date, 6 months ago that had, 10 to 12 people bidding at a closing date. Like you say, they're paying 30, 40, 50 grand over the home report. That's even if 50% of people disappear straight away, then you're still going to have closing dates. You're still going to be getting over and above the home report value probably. So I'm like you, I definitely do not foresee a crash coming, but I anticipate a slowdown for sure. And then you think to yourself, well, what could cause a crash? Because people love the headlines, don't they? I mean, all the newspapers and all that, they love the kind of headlines of property crash on the horizon and all the rest of it. And, there is already those headlines kicking about. And
but that's what I'm saying. Is it a crash or is it a fake thing made up by the media? Because, I mean, I'm the same as you. I spoke to an estate agent yesterday or a couple of days ago that says that a property that I was keen on went 100 grand over the asking price on the first day it went on the market. So someone's not. So if someone's paid 100 grand more, and someone buys a similar property for the market value in 6 months' time or a year's time, the media will get a hold of that and manipulate that and say there's a crash because someone's paid, you know,
Yeah.
100 grand more, now they're paying 100 grand less. And doesn't necessarily mean there's a crash. It means that the market conditions didn't stimulate people paying silly amount over the asking price. So I don't. Yeah.
For me, a crash is like when you go back to 2008. That was a crash. You know, property values dropped by about 20%. Some regions 30%. Do you know what I mean? That's a crash. Can't see that happening again. The banks are in good shape. The mortgage, the banks are wanting to lend. There's a lot of liquidity out there in the market. There's a lot of. It was interesting talking to Kessler Salimi, the mortgage broker. He was saying that even if interest rates, the way that they're going up, they're actually not going up that fast. In the US, they notched up 0.75%. Over here, it was like 0.25% in the last raise. So they're not ramping them up, but you know, people are predicting interest rates to go up to like 3-4%. So my worry was, you know, at the moment on a company buy-to-let mortgage, we're paying about 3.5%, 75% loan to value. And my worry was, right, if we're paying 3.5% when it was, you know, 0.1% base rate through to 1%, you know, if we go up to 3%, 4% base rate, does that mean that we're going to, you know, when our mortgages fixed terms come to an end, are we going up to, you know, 6-7%, you know, mortgage rates? And Kessler was saying, well, there's so much competition in the marketplace of mortgage lending that's not necessarily going to be the case. Do you know what I mean? You could have Bank of England base rates at 3 to 4% and still maybe have the mortgage lending at, I don't know, maybe 4.5%, you know, which people will be like, whoa, that seems high. But really, even if you put that in a spreadsheet, okay, I'm just taking an average. Say I purchased a property 100k. By the way, these figures are totally off the top of my head. You know, you might have a cash flow, a buy-to-let property, cash flowing £300 a month, you know, at the current rates. But, you know, maybe after it hikes up to 4.5%, 5%, then you're maybe looking at a cash flow figure of maybe £200. It's not like that scary.
It's not the end of the world, and the way I look at it is people are going to get scared off by these headlines and put off. But if your property prices have been going up, like we've seen 10% plus average in Scotland for the last couple of years, we're probably going to see similar again. It will settle down. If your portfolio is going up in value, and you know your interest rate is rising, but your mortgage cost is still getting covered by your 10-year cash flow, that's still a good position to be in, because bear in mind you're beating inflation by having your money in assets, and your debt's getting eroded by the high rate of inflation. So I don't think it's such a scary thing when you actually break it down.
I think the other thing to think about as well, you know, what's actually driving the market? It's supply and demand, basic fundamentals of economics. I mean, it's something that I learned in, like, you know, fourth year business studies or something like that. Do you know what I mean? Standard grade business studies. It's like, you know, at the moment, I can't see the supply issue getting solved overnight, because, you know, they're not just going to automatically start building millions of more houses. So you've only got the demand, which could really drop off. And that demand could obviously, the only thing I could see is if we drop into a recession, which is predicted, which I think the Bank of England are going to have to increase rates high enough where we are going to be forced into a recession. And then what happens to businesses? The lending costs for the higher interest rates are going to start having an impact. Are they going to have to lay people off? Is there going to be higher unemployment? These are things that could then filter through, where then the demand could start dropping off. But then you think to yourself, well, rents are going crazy.
Yeah, well, I think demand in properties have been dropping off, because we spoke to Kevin and we spoke to Sam Ross on the podcast a few weeks ago, and they said that applications for buy-to-lets were certainly down. So it's a few brokers who I think we've spoke to on the podcast. So you can see that the demand's perhaps slowing down, but it's not slowing down that much that's affecting prices too drastically, is it? But as I was going to ask you, how are you finding the rental market on the flip side of this then? Because I'm finding that it's hotter than it's ever been, and rents are going up.
Rents are increasing at a crazy level in Glasgow at the moment. I mean, almost unsustainable, like ridiculous. Like a flat that maybe was on the market a year ago, say £700 a month, is now in the market £800 a month. Do you know what I mean?
Mm-hmm.
Like higher than 10% in some areas.
I've got one of my back-lights gave their notice to quit next week. They're moving out, and I was it was a little bit cheaper than market rate at the start. It was £800 per month, but I just got a revalued for rental to see what I could get now. It's probably going to be somewhere between £1,200 and £1,400 a month rent on this property, and I've never increased the tenant's been out for 7 years, and I've never increased the rental. I probably could have or should have, but I'm kind of not one for doing that. Fair just to do it at tenant changeovers. So that's a huge increase from £800 to £1,200 to £1,400. That's a big increase in rental over the last 7 years.
Absolutely, and that's a thing that kind of like you think to yourself, well, if we do hit this recession, which everyone's talking about, then we're probably in a sector where it's not as scary as some other businesses. As having a property business and a portfolio, if you've got rents rising, and obviously our costs are going up with mortgage rates and stuff like that, but even like we say, if it goes to a base rate of 4%, which would be high, we can still probably consume that increased cost because the rents are still going up. And ultimately, in any other business, what they're doing is they're passing their costs on to the consumer, and that's what we're doing in the property because rents are going up. So we're having to pass on our costs as well. The only thing that does scare me about that is, is obviously once the government get involved, and Scottish Government, Green Party, etc., up here in Scotland have publicly said that there needs to be rent controls, and they've got this consultation out at the moment. But that is kind of one worry that I've got.
I think the other worry for me on it would be the affordability on the rent. So probably checking your tenant demographics, where they work, is there kind of jobs recession proof and taking them on. I've been quite mindful of that recently when the management agents have been coming to me with here's an application on your property, and I'm actually paying more attention to look at what they do for a living and if they've got a guarantor as well, because if we do go into recession, what businesses are kind of a bit recession proof and what industries are a bit safer than others.
Absolutely, and that's really good points. And I would also say as well, we do have a lot of landlords come to us for rent reviews and saying, well, should we be putting the price of the rent up? And that, I would say yes, we should be by small increases. But if you're wanting to jump it by like £100 or something like that, then it's not probably a good idea. But like you say, what in terms of buying property, I'm really looking at also what is the local housing allowance like as well in that area. How much are they going to get on universal credit if they're in a riskier sector of employment, and we do hit a recession, they have to fall on universal credit. How is that rent going to look like if they have to go to universal credit? Is it still proven quite a good cash flowing asset? That's something you can look at to kind of recession proof your portfolio as well.
Is the LHA's rates rising with the kind of market rent, or are they kind of still behind now?
No, they're definitely behind, and that's that's a very good point, and that's a big problem.
So will they catch up? How often they reviewed and
I'm not 100% sure. I think they're supposed to review them yearly, but I think traditionally it's maybe been like 3% increases or something like that. So if things are going up, inflation's rents are going up, 10%, I would say on average at the moment, then they're definitely not keeping up. But again, I'm just plucking these numbers out the top of my head. So if anybody knows differently, please put it in the comments. So please.
So we've kind of covered a few areas. In fact, so what would you do then? What's your planning for this? What is it? How is it making you feel? You're doing a whole lot more research than me. Is it making you still want to buy? Are you being conservative on what you're buying and what areas and what?
Absolutely. I mean, I still think there is no better place to put your money than property. 100%. Like look at what's happened to the stock market last week was absolutely catastrophic. If you held, equities and the NASDAQ, I think the tech market over in the US, all these big tech companies took a major pounding. The general stock market's down about 20%, I think, over there. And also things like Bitcoin. A lot of people say, invest in Bitcoin and all the rest of it. That's taken an absolute hammering as well. That was up at $65,000, I think, like last year. And everybody was talking about, Bitcoin's going to get past $100,000. I can't remember what the price is now, but the other day I looked, it was just about underneath $20,000. So that's pretty much, that's just gone into meltdown as well. So where else are you going to put your money? At the moment, I've got a bit of cash in the bank. Right?
I'm the same as you. Like, how can you beat property as an investment vehicle when it's not as volatile? Yes, there's obviously factors we have to consider, and it's not a passive strategy, that's for sure. But yeah, where can you put money right now that's going to beat inflation as good as property investment?
So there's a couple of things that I'm struggling with making decisions at the moment, and everyone's like, oh, this is going to be the opportunity that we've been waiting on. In a rising market now, this is all coming to an end. People have been struggling to find deals. Now everybody's seen the doom and gloom, and they're thinking, oh, there's going to be deals on the horizon. Really juicy deals coming up. I don't think there is, and I think still, if you've got money sat in the bank, for me, it's still much better sitting in property, like you say, where it's beating inflation and just providing you a nice, decent cash flow income. Plus, you're getting that increase over time as well. And it all boils down to your strategy and your time scale as well. So for me, it's like 20 years, so it doesn't really matter. The other thing I'm thinking about as well is fixing in. I need to fix in as much as possible for 5-year fixed term mortgages where you're getting a really good rate. Some of the 5-year fixed rates are better than the 2 years at the moment. So
that's weird, yeah.
So if you can fix in a 5-year, hopefully you can ride that. If there is a recession, hopefully you can ride that out as well, and that provides that stability for your portfolio.
Yeah, I know. I agree. I've got probably 3 or 4 mortgages I've kept on variable rates after their terms had ended in the last kind of 6-7 months, because it's ones that I'm planning on selling. A couple of my own personal name and a couple of limited company. So, as soon as the interest rates go up like they did last week again, you're getting the letters constantly coming through with the new increased payment. So yeah, I'd agree if you were kind of sitting there long term and you could fix them for 5 years, why not? The costs are the ones I've saw. The costs were pretty much exactly the same as fixing for 2 years. So take that a bit of a longer term view and fix it. Know what your outgoings are going to be for the next 5 years and ride it out and try and look for the new opportunities.
I have been thinking about a lot lately about debt and the kind of leverage on the portfolio as well, because I'm thinking originally my exit strategy was over 20 years I'll build up a portfolio of 20 properties, interest only mortgages I always invest in, and then over that time the increase in equity, I'll maybe sell half the portfolio, keep 10, this is just again average numbers, and pay down the debt on the remaining 10 that I've built up the value increase over time. But lately I've been thinking, the guys that I've been speaking to that are on interest and repayment mortgages, it does sound quite good at the time of trying to reduce your exposure to rising rates.
No, I'd agree. I've got a mixture of interest only and repayment, and I always do it for interest only when it's in the limited company and you're during acquisition stage. But once they're refinanced and settled in the portfolio, I like to try and get them onto repayment. But like you were kind of touching on earlier on, if you've got property, if you've got interest rates coming up to 5-6%, and you want to then go and put it on a repayment, you might actually wipe out your cash flow fully. But again, this all comes back to your own personal strategy and goals for your property. You might want to have them debt free in a shorter period of time. The whole portfolio debt free or a low loan to value. But yeah, I think you've raised a good point there, Nick. It definitely is worth considering your loan to value, your exposure, what your lending is right now, and probably try and be as liquid as you can as well.
Well, that's the thing. I'm personally quite liquid at the moment, right? But I'm kind of I definitely want to get it into property. The quicker the better, because I just think that if I wait out, everyone's like, oh, should I wait for the deals coming up? But what if, like we've talked about, we don't anticipate a crash and things, you're going to lose that maybe 5% over the next couple of years. Then you're going to look back at it and go, oh.
I think we'll see a huge amount of repossessions coming on. I went and viewed a few repossessions last week, and some of the agents were saying that that's the first ones that are coming back to the market since COVID. So I think, as cost of living keep increasing and the squeeze gets put on people, and obviously, recovering from COVID, I think we'll see a lot of repossessions coming on the market. You never know. I mean, the cost of living crisis and the huge costs that we're facing right now, it could seriously affect people's ability to afford their own homes as well, and you might end up finding properties are getting repossessed over the next year or two as well, and that does bring on good investment opportunities as well.
Yeah, and I've been listening to a lot of Bloomberg and all that over in the States, and God, if you think we have negative headlines and sensationalism journalism, God, they're even worse. Do you know what I mean? They're predicting the worst housing market crash since the deep depression of the 1920s or something like that. Do you know what I mean? No, I don't think it's as bad as that, but yeah.
Does headlines like that stall stimulus in the market? Does it put people's, puts a scare factor in people that they don't want to sell their property, and obviously then that starts stalling the market a little bit? But then that's kind of what happened in COVID, and prices increase, not decrease.
Yeah, no, 100%. It's obviously, market sentiment and, consumer confidence and all that is definitely, people be reading the news at the moment and be like, no, like we need to put money away. Like that's their whole strategy, isn't it? That's also how, because the Bank of England can only do, the Bank of England can only do one thing really, and that's their only kind of lever is interest rates. So they'll be hoping as well that the public will do their bit and start like saving money away so that it reduces that inflation, because that's what's causing inflation is everybody's out there spending and putting the demand on a decreased supply. Do you know what I mean? So that all kind of falls into their battle plan as well. So they want these kind of headlines.
No, absolutely. Yeah.
So any comments, guys? We'll take some questions here while we're on, just to wrap up. We wanted to make this quite a quick, short and sweet one here, but so do you think these prices will actually come back down? Well, I don't think so. I think if anything, they might flatline, the worst case scenario. I can't see a crash, can't see a drop. Stephen?
Yeah, I'm a bit in the same boat a little bit. I think we might see, depending on how the cost of living goes now, how we can curb this massive inflation. If we see repossessions coming on and coming through, and people struggling to afford their homes, we might see product prices decrease because investors like us will probably snap up cheaper properties. But again, it's all market sentiment. Market sentiment in the last 6 months, couple of years was good. People were paying over the asking price, and there's a lot of people doing it. If the scaremongering comes in from the media and you get some repossessions filtering through, do we then get opportunities to buy properties, 20-30% below market value instead of paying 20% over? And then there's a difference in it. So yeah, there'll be opportunities to buy, but I don't necessarily see a crash coming. It'll just be what you can pick up.
I think first time buyers going to have a bit harder time as well, because they're going to struggle to get deposits together as well, because they're just not going to have that leftover money at the end of the month. Do you know what I mean? So that could have an effect as well. And the first-time buyer market is a huge part of what drives house prices. If you think about the investor market and the buy-to-let landlords, that's a tiny, tiny proportion of the overall housing market. So we might be sitting here, without a problem, but there's plenty of people on lower incomes that are maybe just starting out in the housing ladder that might be struggling. A couple of comments here. Winter discontent coming our way. Absolutely. There's going to be another hike in energy prices. Inflation predicted to peak at 11%. Absolutely. Another comment here. Get your cash into property before it's all raised away. We've touched on that as well.
I've been telling Nick for the last 2 years.
I know I've wasted an opportunity here the last 2 years where I've had a bit of cash in the bank, where I've lost out on that 10% growth. So to be fair to me, right, I have been concentrating on building my lettings business, which will hopefully see me in good light as, things might hit hard times. I've got a business asset there, so I've got a fallback. If you've just sitting there living off your cash flow as with your property portfolio, your cash flow is going to be affected when you come off these fixed rate deals.
That's a very good point, actually. A lot of people try and jump into full-time property and living off the cash flow of the portfolio. But yeah, that's why I like doing a lot of different strategies, like you say, different businesses, flips, sourcing some deals. So if you've got a multiple kind of income streams in property, then you're not as exposed to it because you're not relying on your portfolio income. Good point.
Yeah. I think we've hit, somebody else is saying here, I think we've hit the peak property right now. Well, that's what we're saying. Data's definitely come through to suggest that, reduced mortgage applications and properties longer on the market and stuff like that. Yep. Another comment saying, correct regarding buildings not meeting demand for houses. So I think that's always going to be a problem. we talk about this housing crisis. There's been a housing crisis for the past however long I can remember. There's always going to be a housing crisis. Investors may now be sitting back waiting to see what happens. People don't want to buy at the peak of the market. We've touched on it. I think if you're sitting back, then you could be wasting, a lot of good opportunity as well. There's still, bottom line is there is still deals to be had. We see it on a daily basis, people putting stuff on Instagram, Facebook, part of our community that we've built. There's definitely things to be done. I don't like this, let's sit back and wait to see what happens. Although I have been guilty of it a wee bit myself.
You've got an excuse for building your business in the background, but I agree. You can find deals in any market, up or down. It's been a bit more difficult recently, but it's not been impossible, and they've certainly been there. They're still there. I got 3 secured last week in Aberdeen, so there is deals out there. It's just finding them. They're getting a bit more trickier, but they're there. Hopefully, it might be a bit easier in the coming couple of years. But I agree with not sitting back, continuing to keep moving forward.
Yeah, and as we wrap up, guys, any more questions just to round up the last couple of minutes? Comments or questions, stick them in, we'll fire up on here. Somebody said, everything at council level will take a long time to change. There will always be a lag. That was referring to the local LHA rates, universal credit. That's your kind of fallback, your kind of guarantee, if you like, if your tenant does get made redundant or unemployed.
That's not a bad point. Again, I'd like to touch back on that. Is that something you would do on your portfolio to safe bet? So I know that when we stress test our portfolio purchase, we usually test it at 5.5% interest, whatever. Is it worth testing it on that rental income at LHA rate, not the actual market rent, if that's lower than the market rent? So you can't quite get the peak.
It could definitely be a wee separate field. I've not seen it in many spreadsheets, but if you put that in a spreadsheet along with your deal analysis, then I think that could be quite a useful tool. I think you probably, unless you're buying in the kind of like certain range of say 60 to 80,000, past 100,000, it's probably not going to look too great in terms of cash flow. But again, it's a good one to think about. Hi guys, do you think it's ideal to pay early repayment charges and just to lock a lower interest rate while it's not up at around 3-4%? That's an interesting one. So guys, we're not mortgage brokers. Obviously, you need to go and get the correct, professional advice. But I don't think it probably, the early repayment charges can be quite substantial. They can be quite expensive.
I suppose it depends on what point you're at in the mortgage, because I think they go down from 5%, in your first year, 3%, 2%, 1% as the kind of your fixed term goes down. So it depends, I suppose, on what your redemption payment is, and then what would be the cost saving now by Xing early and the savings per month on the new fixed term. But you could probably get your mortgage broker to show you the illustrations of all the options. They'd be able to do that for you and show you the cost over the few year period.
Yeah, and let's just look at where we are with interest rates. So we started off at like 0.1%, and then over the last 5 or 6 months, every meeting that they've had, I think they meet round about once a month, but sometimes I think over the summer they meet less. But they put them up in 5 consecutive meetings, 5 consecutive months. They've put them up 0.25% on the base rate, right? That doesn't translate into your mortgage rates necessarily unless you're on a standard variable rate deal, where I've got one actual property that I keep getting a letter every increase. The letter comes through to say your repayments have gone up. But if you're on a fixed rate, it's not going to affect you. But what I'm saying is that just because it's gone up 1.2% or whatever it is, that hasn't really related to the new fixed term deals. They've not jumped them up by that much.
Talking about mortgages there, we had Sam Norris on the podcast a few weeks ago. He was mentioning about an explanation of how the mortgage lenders borrow money from the big banks like the Bank of Scotland or your Royal Bank of Scotland. They borrow a certain percentage and they put that pot out to us for our products. Yeah. So I've got a mortgage deal with Aldermore that I got offered back in November. So we're 7 months delayed and it's not completed yet. So obviously my panic's been setting in the last couple of months as interest rates have been going up. saying this is going to get pulled. So the offer expired last Monday, and I kind of tried to motivate the solicitors who are dragging their feet with this to get this through. And the solicitor who that's appointed by Aldermore, so they contacted Aldermore and said, "Can we get an extension on this?" Now I thought, no way. It's went up 3 times the interest rates. There's no way they're going to give it to you. If you think about it, why would they offer me at such low rates from November's rate when they could be getting a hell of a lot more now? But they did. They extended it by 30 days to get this over the line. So it's settling next week. But I wouldn't have understood this unless I'd listened to Sam on the podcast the other week there, and he was saying basically that's the pot that Aldermore's obviously got.
Yeah.
And they've already allocated it out to lend at that rate. So once that's all gone, then it's a new rate. So I found that quite interesting. So we have got mortgage or applications in, get them in and try and get them fixed now.
Yeah, no, absolutely. And again, just there's a lot of competitive there's a lot of competition in the mortgage market, and the banks and the lenders are quite liquid, and there's a lot of money there to be lent out. So I don't think that's going to be a problem. Definitely can't draw any comparisons to 2008 anyway. So guys, I think we'll wrap up there. Hopefully you found that useful. As always, don't take this as financial advice. Don't take this as mortgage advice. These are our kind of experiences. We're obviously out there, doing deals, building our portfolios. So this is just our opinions.
And we seem to get it wrong. If you listen back to before COVID and what was happening through COVID, I think we predicted it wrong as well. So it is just our opinions. Take it with a pinch of salt. Use what you find useful, but do your own research before you start looking to grow your own portfolio.
Definitely. So as always, appreciate your support on the podcast. Head over to Eventbrite if you're interested in getting some in-person networking, guys, getting in the room, making some contacts, doing some deals. We've got events all over the country, Stephen.
Yes, absolutely. Glasgow, Edinburgh, Dundee and Aberdeen on the first Wednesday of every month. Nick, who have you got in Glasgow this month?
We have got our guest speaker, John Paul Riley, is going to be talking about, he's a business coach. So we're going to be talking about scaling, growing your business, how you should be outsourcing tasks to get more done. A lot of the pains that we go through, because we are growing small businesses, and how you can manage that, useful tricks, tools, tips to help you grow that property business.
Superb. And I'm up at Dundee joining Keta Salimi this month. So I've not been to the Dundee event yet, so I'm really looking forward to that.
Good stuff. And Aberdeen and Edinburgh as well, doing really well. We've got Trish Crooks up in Aberdeen with Chris Minchin, Linda Martin and Gary Wales down in Edinburgh. And it's great to build the community. I'm really loving it and making connections. Love the networking.
Absolutely, guys. So if you want to jump on to ScottishPropertyPodcast.com, where you can find a link to Eventbrite to get your tickets.
Thanks for listening, and we'll see you again next week.
Thanks, guys.